Greetings, Terry students, and congratulations on being part of the #1 ranked risk management program in the country. My name is Joe Hamilton. I'm a producer with USI Insurance Services and a proud graduate of the University of Georgia Risk and Insurance Program in 1980. I've been a producer for 40 years. I am very thankful that Cecil would give me an opportunity to address the class today, though I'm disappointed that we can't do that in person, but this will have to do for the moment. Cecil has asked me to talk a little bit about marketing and distribution, which I'm happy to do. I'm going to try to cover really two separate areas in the next 15 minutes or so. The first is to present a model for a risk management continuum that we use for our clients and help you understand how that might help the clients. Secondly, I'm going to talk about the skill sets or characteristics that help people be successful as either producers or in looking for clients or prospective clients. The management consultant Peter Drucker says that every business has two chief aims. One is to innovate and one is marketing. He defines marketing as creating new customers. In my world, it is equally important, if not more important, to keep existing customers. Working at USI, I'm part of what we call the American Agency System. USI has contracts with insurance carriers. I go out and interface with clients and try to pair my clients with the correct carriers. To do that, I have to have a keen understanding of what my clients are actually doing, and the way I see it, a 6-step process to do that. I'll give you the list, and then we'll go back and talk about each one, and I'll try to give you some examples of some. But the risk management continuum starts with being able to identify exposures to loss. Secondly, to quantify those exposures, to understand how that loss could affect a firm financially. The third concept is avoiding the risk. The fourth is mitigating the risk. The fifth is transferring the risk. And the sixth is accepting the risk. Pretty much all the processes that we go through to benefit our clients are in one of those categories. And when you look at that list, there's one word that's not on the list that perhaps you might expect to be there. That would be the word insurance. And I believe that Cecil has talked about transferring risk and basically moving the risk from one treasury to another. And I think that's a really, really good example. So where we will talk about insurance is in the transfer section, which is actually the 5th step in the process. And I think it's important to note that you look at the other options before you deal with the insurance option. So let's start and talk about identifying exposures to loss. Obviously, the worst way to handle a risk is through unconscious self-insurance, meaning you didn't even know you had it and suddenly you've got a loss. From a identification standpoint, anything we fail to identify may end up in that category. So identifying the risk is critically important. I'll give you a quick example of that might be familiar to you, and that is when the I-85 bridge caught on fire. The roadway authority, the Georgia Highway Authority, actually had property insurance for their bridges. Interestingly enough, I understand that they did not have coverage for fire, for the very simple reason is they didn't think a bridge could burn. So in that case, they failed to identify an exposure to loss that ended up creating a problem. Once you are able to identify those exposures, then we use analytics to try to determine, using frequency and severity as kind of the benchmarking to determine how much damage could that do? I'll give you an example of that. I have a client with a large manufacturing facility in Shreveport, Louisiana. Obviously, it's been imperiled several times by hurricanes. And of course, we've done some analytics around that to determine if you're struck by a Category 5 hurricane, how much damage is going to be done to the building. And on top of that, and perhaps more importantly, how long are we going to be out of business? Of course, in that case, you have to factor into the process not just the cost to rebuild, but also some modifications, because the cost is going to increase because all the contractors are busy at that point in time. Relative to quantifying loss, there's another very interesting case back from 2001 where a real estate developer bought a property in New York. Actually, they purchased the property from the New York Port Authority. They looked at the loss. They decided they actually bought, I think it was 7 buildings at the time. And instead of buying insurance for each individual building, the real estate developer said, well, let's do some analytics. Let's determine that how much we could actually lose. So they decided that they could only lose 1 building at a time. They ended up buying a loss limit policy that has a single limit per loss as opposed to individual coverage for each building. And before the policy was issued, unfortunately, they had a very significant loss. You've probably figured out by now I'm talking about the World Trade Center. That stayed in litigation for quite some time. It has gotten resolved, and unfortunately, the real estate owner came out on the short end of that. But once again, the failure to properly quantify the loss created a significant problem. We talk about avoiding loss, and you can avoid loss. We've worked with clients before about doing acquisitions. We had one where there was a significant products liability loss that or the potential for products liability loss, and they ultimately decided not to purchase the company because of ongoing liabilities. And obviously, if you avoid the loss, if you avoid the opportunity for the loss, you don't have to worry about it. And analytics is very important to help and determine that. Mitigating loss is another important part. We think about loss control as being the most common way to mitigate loss. Also, I got a story there. We have a real estate firm that has a beautiful office building in downtown Atlanta. It has 2 large marble staircases that drop about 25 feet from an entry hall down. They started having a lot of slip and falls on on the marble steps. We sent one of our loss control engineers out there who was able to ascertain that they had changed building maintenance companies, and the new maintenance company was using a different compound to clean the marble. And that was creating the slip and fall. So we had to correct that. But that's the type of thing we do. Once again, I haven't really mentioned insurance yet in this process. The good news is we get to that with transfer, but not quite yet. Because the first transfer is a non-insurance transfer through a lease agreement, through a contract, through a purchase agreement. And give you an example there. It's actually a client that Cecil and I both worked on together. It was a large general contractor. He was working for a different firm. We were competitors, but both working with the same client. This particular client was building a pedestrian walkway at the Atlanta Botanical Garden, which unfortunately collapsed. There was 1 person killed and I think 21 injured. Well, because in that case, we had worked with our client to properly design their subcontractor agreements, the loss was captured by the subcontractors, not the general contractor. It was actually their fault. Our contractor agreements not only indemnified the general contractor for the work of the subcontractors, but also backed that up with insurance, and we were listed as additional insureds under their policy. So what was a pretty significant loss ended up not having to be paid by the general contractor because of the non-insurance risk transfer. Now, the good news is they had all the insurance they needed, so they did have insurance had it gotten to them, and that's the whole issue around insurance transfer. Cecil's point, transferring the risk from one treasury to another, or the potential risk from one treasury to another. Anything that then makes it through the system becomes accepted risk. And once again, it's important that you understand what that risk is and you're able to quantify it. You can accept risk in any part of the process. For example, each one of you makes a decision to accept risk when you determine what type deductible you should have for your automobile insurance, for example. And we are able to use analytics to plot what we call an efficiency frontier, where we can say, if you take this deductible, you're going to save this amount of money. But of course, in order to make that a realistic projection, then we're going to help them calculate what's called total cost of risk, which in the case of an automobile insurance issue with a deductible isn't quite a big deal. But when you're dealing with, for instance, a workers' compensation program with a $250,000 deductible or self-insured retention, that means that company is going to have to pay a lot of dollars in deductibles. So they may save money on insurance, but ultimately have to pay more depending on how their losses run. So we do a lot of analytics around the losses to help them understand how much of that risk that they want to accept. And part of that is what's acceptable to them, not just from a financial standpoint, but from a psychological standpoint. Are they more risk averse? And that gets back to knowing your client. There are three kind of rules of risk management also, that we take that risk management continuum and we force it through a lens. And the lens has three rules of risk management. The first rule is don't risk more than you can afford to lose. As a corporate risk manager, you need to make sure you're protecting the financial assets of the enterprise. The second is don't risk a lot for a little. Historically, we've been able to buy pretty significant umbrella limits, for example, and create what's called, quote, sleep insurance, unquote, where risk managers don't have to worry about having excess limits because they've got sufficient. At this very moment, we are in a very hardening market as it relates to excess casualty, meaning the premiums are increasing so precipitously that risk managers who are currently, or let's say last year they bought $100 million, they might buy $75 million this year, and they're likely paying the same or maybe more for the $75 million than they paid for the 100. So we're having to relook at those decisions. And I think that's an important thing because it is a dynamic process. It changes. We've got to be ready to shift with the market and with different insurance buyers as need be. So three rules of risk management. The first I mentioned, don't risk more than you can afford to lose. The second, don't risk a lot for a little. The third is consider the odds. Back to my facility in Shreveport. What are the odds that it's going to get hit by a Category 5 hurricane? That may determine how much deductible we're willing to take. Frequency and severity are normally the things that we use to measure that probability. Consider the odds. Wanted to pivot for a minute and talk about what we see in terms of how I would pursue a client, for example, and what clients I'm looking for. I've had producers tell me that everybody that's breathing is a client. I don't think that's the right strategy by any way, shape, or form. I have an E&R 100 contractor who's a client who is quick to say that the most important jobs that they get, the most important jobs they look at are the ones they choose not to take. They've gotten very good at understanding who they can be successful with. And I think that's important for us as individuals based on the resources of our firm. And I would suggest that while we are selling insurance, we are basically in a client service business. We're trying to take care of our clients' needs in that risk management continuum and beyond. Part of that is becoming a trusted advisor to our clients. We do that by knowing their business, by thinking ahead of the curve relative to what their needs are going to be, understanding what's going on in the market, understanding their business, and ultimately supporting the efforts of the risk management team in that company. And it's interesting, and we just had a client that had a change, and it required us to sit down with the new risk managers and understand, what is your strategy? What's your philosophy? And we need to be able to meet that. There are clients that we do better with than others, and I'll talk to you about kind of prospective clients in a second. But back to kind of the role of insurance broker, it's also relationship building, developing a comfort level with them and letting them develop a comfort level with us. A big part of that is simply doing what you say you are going to do over and over and over again. Most risk managers don't want to be surprised with bad news. So there's a whole public relations maxim about running toward bad news, not away from it. And I adopted that a long time ago with my clients because I don't want to know something that would be detrimental to them that they don't know. That relationship is also important as it relates to working with insurance carriers and working with other vendors. I have a couple of underwriters who I work with today who were classmates of mine at the University of Georgia 40 years ago. And those relationships mean a lot in this business. So I would encourage you to take that part of this seriously as well. So I mentioned, what do we look for in a prospective client as opposed to what the producer's role would be. In a prospective client, I want to make sure that they need my help. Is it someone who, if it's a florist shop, everybody can do that. They don't necessarily need my help. On the other hand, if it's Delta or Coca-Cola, those are firms that I may not be able to help. I may not have the right resources to help them. So I need to know what my sweet spot is. Am I the right solution? Do I have the right capabilities, basically, to be able to meet their needs? I ask that they listen to my advice. As we said earlier, we spend a lot of time understanding their business. I want them to listen to the suggestions that I make, and I would like to have access to the decision makers, which is something else. Therefore, the message doesn't get lost in translation. It's easier to talk directly to the people who are making the decisions. I ask that they pay me. Early in my career, they used to say you don't have the deal until you have the check. Well, in today's world, very seldom are we actually getting a check. But the same is still true. We expect to be paid for the work that we do, and we expect to pay them when they have a claim. To be honest, to be fair, to tell the truth, and those things will serve you well. Once again, doing what it is that you say you are going to do. So the first part of that analysis is really kind of the role of the insurance broker with the client. The second part of that analysis is what we look for in a client. I am going to be on the line, I think, with you for Zoom. I'm happy to answer any questions you may have. I hope that if there are things that I can help you with in the future, you'll call on me. I would also tell you, you should be very appreciative to have somebody like Cecil. Cecil is a person who cares very much about our industry and cares very much about each of you. So look forward to being with you on Zoom in a little bit, and let me know what questions you might have. Thank you for your time.